I've continued to read in the media that the RBA is going to not just cut rates, but aggressively cut rates as we move through the year. So it was a surprise to me to read the minutes released last week of the RBA meeting of 5th and 6th of February. They start on page 1 by noting that global inflation remains high. They say that rent inflation has yet to show clear signs of easing in many economies, including Australia, and overall services inflation remains higher relative than pre-pandemic rates. They talk about China and the Chinese economy weakening, but they said that weakness was expected to be partially offset by continued strength in manufacturing investment and further policy support for infrastructure investment, and these additional measures had supported Chinese steel production and in turn the prices of iron ore and coking coal received by Australian exporters. They noted in Australia that services price inflation, which largely reflects conditions in the domestic economy, had declined to a significantly lesser extent and remained high. And they noted that as far as the total economy was concerned, aggregate demand remains above the economy's ability to supply. And they come back to this point a number of times during the minutes. They say that services inflation remains high and was expected to still decline, but only gradually as aggregate demand moderates and growth in labour and non-labour costs ease. Again, they come back to the statement that members agreed that aggregate demand was still high relative to the economy's supply potential, and this was generating inflationary pressures. And then they turn in the minutes not to the case to cut rates, but to the case to increase rates. They say the case to raise the cash rate further centred on the observation that it would take some time for inflation to return to target and the labour market to full employment. Inflation was expected to take a further 2 years or so to return towards the midpoint of the target range under the central forecast. Members noted that an increase in the cash rate at this meeting could slow the growth of demand further and reduce the risk of inflation not returning to target in an acceptable timeframe. Increasing the cash rate now would not prevent the board from easing monetary policy if the economy were to weaken more sharply than envisaged. However, the members concluded that the staff's central forecasts were for inflation to return to target within the time frame that they previously found acceptable. What's important here is that right now they're holding inflation, the cash rate where it is, because inflation is falling in line with the target. But they see a whole lot of reasons, particularly in services inflation, why that decline in inflation could be arrested. So the chance of holding rates or even a rate hike is much higher than most people think. Given these observations, it was reasonable to conclude, however, at the meeting, that leaving the cash rate unchanged at the meeting and continuing to monitor the risks as the outlook evolves was the most appropriate course of action. So in weighing up those two options, the members judged that the case to leave the cash rate unchanged was the stronger one. But what's apparent in these minutes is that they say domestic demand is higher than domestic supply, and that is inflationary. And there is still significant problems with services inflation in Australia. So that there is still a significant chance that rates might have to go up, not down. Right now, they are holding rates exactly where they are. But are rate cuts a shoo-in from here? Wait a minute. Just look at these minutes. That's not what the RBA is saying at all.